Thanks everyone for joining us this afternoon. Today we're going to be talking about cover call strikes and the optimal cover call strike. We're actually quite excited about doing this webinar because we've done these income strategy webinars in the past, but we've been compiling some data over the last few months, looking at back testing, looking at forward tested results, and really trying to understand, when you're selling cover calls, what strike prices should you be looking for? How do you pick your expirations and your strike prices? So we've been doing, tens of thousands of back tests, and now we have some data to show that's very interesting to show you. So today what I'm going to do is I'm going to talk a little bit about the basics of cover calls, but more importantly, we're going to talk about how can you achieve consistent returns or consistent income returns using cover calls, and then get into some of the nuances between how you select your expirations, how you select your strike prices, and from our testing, what we see as, the best way to go about doing so. And then lastly, what we really want to do to help tie all this together is we want to show you how you can accomplish everything that we're showing you today using the OptionsPlay tool that's available to you for free at First Trade. This will allow you to very quickly find the optimal cover calls for your individual portfolios. And then lastly, what we'll do is we'll cover a little bit around exit strategies. So with that in mind, I'm just going to go right ahead and jump into it. Okay, so talking about the basics and benefits of cover calls, just for those of you who are new, who have never traded a cover call, the benefits of a cover call is it generates consistent income by selling calls against the stock that you own in your portfolio. And the great thing about this strategy is that you can do it month after month, and that's what we talk about, the consistent income stream, is that every single time a call expires, you can do it again and bring in some additional income. And by doing so, what that does is it lowers the volatility of your portfolio, which lowers the net cost basis of the stock that you own. So you can essentially continuously lower your cost basis on the stock that you own by generating this income. And the best part about the strategy is that it's used on the stocks in your current portfolio. You don't have to buy any additional stocks. You don't have to buy anything new. You can use the existing buy and hold portfolio that you have to generate some additional income. To do so, there are some limitations on your portfolio to do so. So first of all, what it does is that when you sell a cover call, the strike price that you choose, you're limiting the upside return of the stock above that strike price. So if you're expecting a stock to really take off, or you're expecting a stock that you want to appreciate over the long term, this might not be the strategy for those specific stocks. And it does require a minimum of at least 100 shares. So if you have some stock in your portfolio where you only have 50, 60, 70 shares, you can't do the strategy. You have to have at least 100 shares of each stock in order to sell a cover call. And then lastly, you do risk losing that stock. So for different accounts, that may mean different things. Could potentially become a taxable event in your regular accounts. So you do risk losing that stock when you're selling a cover call. So those are just some of the basics and benefits of cover calls. I'm presuming most of you are familiar with this type of strategy. So we're just going to move on and really talk about the intricacies of, how do you get consistent income through a strategy like this. So first of all, when we talk about cover calls, what we should really point out, number one, is that it's not a one-size-fits-all strategy. And when it comes to selling cover calls, there's two things that you really need to look for, is your time frame and your risk tolerance. So I just want to talk a little bit about these two preferences so that we can help you identify which one you fall under. Okay, so when it comes to cover calls, you have to do two things. You have to pick an expiration date and you have to pick a strike price. So when it comes to expiration dates, first thing you want to ask yourself is, how often do you trade? And that will allow you to figure out what you trade very actively and you have the time to look at your portfolio and every single day or at least multiple times a week, then you generally speaking want to be on the shorter end of the spectrum. You want to sell cover calls that expire anywhere from a few weeks to about 2 months out. Depending on the stock that you sell, you're going to usually be able to find expirations in that time frame. On the other end of the spectrum, for a lot of you that are long-term buyers and holders, maybe you might look at your account once a month or maybe once a quarter. You're not very active in your brokerage accounts. For those types of clients, you want to sell calls that are somewhere from 3 to 6 months out. And then lastly, for those of you that are somewhat in between, you might want to look out about 2 to 3 months out to pick your expiration dates. So before we move on, make a mental note to yourself. Think about how often do you trade? How much time do you have to dedicate to looking at your portfolio? And make a mental note to yourself kind of which time frame do you fall under. For risk tolerance, which is really regarding how do you find which strike prices you sold. So we just talked about figuring out which expiration you should sell. Now let's talk about which strike prices should you sell. Now that really comes down to risk tolerance. For someone who's conservative, and what I mean by that is if your goal is to make sure that you hold on to your stock, and this is generally speaking reserved for users who you've held on to a stock for a long time, or maybe you have stock that you rely on the dividend for income. You really want to make sure you keep that stock. You don't want to lose that. You would fall under the conservative end of the spectrum. So this is where you want to shoot for calls that have about a 90% chance of expiring worthless. And for those of you that are familiar with an option chain or familiar with the Greeks, that's approximately a 10 delta call, meaning a 10 delta call gives you approximately 90% chance that that call will simply expire worthless. On the other end of the spectrum, there are some of you that are very aggressive when it comes to your risk tolerance, meaning you're looking to maximize your yield on the cover call. You're not afraid of your stock being called away. You're okay with that. If that's the case, you fall on more of the aggressive end of the spectrum. Then you want to shoot for something with about a 70% chance of expiring worthless, or approximately a 30 delta call. And lastly, for those of you that fall somewhere in between, which is probably where most of you are, under the optimal spectrum, you want to shoot for calls that have approximately an 80% chance of expiring worthless, or approximately a 20 delta call. So make a mental note to yourself, kind of how often do you trade? So do you fall into the short, medium, and long term? And then how aggressive or conservative you are when it comes to risk tolerance? Are you conservative, optimal, or aggressive? Because that is, in terms of finding the cover call that suits you best, is as simple as choosing the time frames that meets your criteria. So we'll talk a little bit about that. So when we're talking about cover calls, the most important thing that you want to look for is how do you get consistent income returns? And the reason I say that is because if you have 1 month where you get a nice fat income and the next month you get a very little amount of income, that's not doing you any good. You want to make sure that you want to generate relatively consistent income returns month after month. So how do you do that? It's actually really simple. It's just basically taking what we looked at on the previous slide and making sure that every single time you go to sell a covered call, you're choosing an expiration date and a strike price that suits your trading frequency and your risk tolerance. So choosing an expiration date that suits your time frame, choosing a probability or strike price that suits your risk tolerance. Once you've done those two pieces, the call that you select from that will you can calculate the yield of that call. Sometimes that yield might be 1%, sometimes that yield might be 5% or 10%, whatever that is. A lot of times people will ask me, how do I know if that's enough yield, or how do I know that that's a good yield? And that's a great question. And the easiest way that I usually try to answer that question is I use the dividend yield on that stock as my gauge to see if the yield on my cover call is good or not. So if I have a stock that pays a 1% dividend, I have a cover call that pays a 5% yield, then that's a pretty good boost, right? Because I'm only getting 1% if I hold on to the stock from the dividend. But if I add the cover call, now I'm adding 5% to that. So my yield went from 1% to 6%. That's certainly an attractive return to get in exchange for giving away upside of the stock. Conversely, if let's say you have a stock that pays a 5% dividend yield and you're looking at a cover call that only pays you a 1% yield, then you're only boosting your returns from 5% to 6%. That might not be worth your while. So my rule of thumb is I usually use the dividend yield, and I want to at least beat the dividend yield in order to write a cover call. So to justify the risk of losing the stock and giving up the upside, I want to get at least the dividend yield on a cover call. So those are the two things that you really need to look for, is choosing an expiration and strike price that meets your criteria, and then using the dividend yield as your guide to say, is there enough yield in the strike price that I've selected. So that, is a very simple yet holistic approach as to how you can generate consistent income returns using covered call strategies. So now what we really want to talk about is the intricacies of expiration selection and strike selection, and talk about the trade-offs that you're making. And then what we're really going to do is tell you what our research has shown as to what you want to really optimize for. So when we talk about expiration, like I said before, there's three settings. You can be a short-term, medium-term, or long-term. So short-term is anywhere from 21 to 49 days. Medium is 50 to 89 days. Long-term is 90 to 180 days. So the longer you go out, or the further expirations you go out, the higher the premiums are, right? The shorter the expirations, the less premiums you get from your covered calls. However, with the short-dated calls, you get more certainty because there's less time that can go between now and expiration. The further out in time you go, the less certainty you have of what's going to happen between now and expiration. So the question becomes, what's more important, or where should I find that balance? And from our research, what we found is that where you really want to be doing is you want to be optimizing around having more certainty. So more certainty from our research is way more important than anything else when it comes to selling covered calls. Meaning what's more important is for you to sell shorter dated calls for less premium, but doing it over and over again. Meaning each time you're going to have more certainty that you know where the stock may end up with between now and expiration. And it's okay to take a little less premium for that, because it's better to do something with more certainty more times. So for example, if you sell a 1-month call, you can do that 12 times a year. And then when you sell a 1-month call, only 4 out of those 12 cover calls that you've sold will include an earnings expiration in there. Conversely, if let's say you sold a long dated call, let's say you sold a 3-month call, you can only do that 4 times a year. And it's likely that every single time will have an earnings call inside of it. So basically, if you sell a long dated call, 100% of the calls that you sell throughout the year has quite a bit of uncertainty in it. Versus if you sold 1-month calls, then only about 25% of those have a bit of uncertainty in there because of earnings and corporate actions. The other 75% should be relatively certain. So this is why, based on our research, when you're trying to select expirations, our research shows it's better to have more certainty with the short dated calls than to have less certainty with more premium. Moving on to the next page. This always happens to me where I can't move on to the next page. 1 second, sorry about that. Now when it comes to strike selection, same thing. You can do the conservative, optimal, or aggressive. The conservative, which is the 10 delta or something approximately 90% chance of expiring worthless. The aggressive is about a 30 delta or a 70% chance of expiring worthless. Same thing. So the more conservative you are, the less premium you're getting. The more aggressive you are, the more premium you're getting. However, the trade-off between that is when you're getting very aggressive, you have less upside, meaning the stock doesn't have to move very far before your stock gets called away. Versus if you're very conservative, you have a lot more room for that stock to go higher and still receive that capital gain on the underlying stock. So the question again becomes, where do you want to optimize for, or what is best for you long term? And based on our research, same thing. It's best to be on this end of the spectrum where you get more upside. Upside is more important than getting more premium. So what we've actually found from our research is that the optimal call is somewhere around a 16 delta. So it's actually right in between the conservative and optimal, closer to the optimal side. That the 16 delta calls give you a good risk reward long term, meaning it's better to make sure that you capture upside of the stock, because the last thing you want to do is limit how much your stock price can go up by during the time you sell covered calls just to get a few extra cents or a few extra dollars in premium. Not worth it. So that's what we found from our selection. So just to sum up, when we're talking about covered calls, what we really want to look at is optimal covered calls. We want to take certainty over high premium. So we want to do shorter dated calls, and it's okay to give up some extra premium for that. And when it comes to strike prices, we want to make sure that we don't limit our upside returns, that's more important than bringing in additional income. So make sure that those are the two things that you think about when you're selling covered calls. So we found that the optimal time frame is somewhere between 3 to about 5 weeks out or 6 weeks out in terms of expirations, and then the strike price approximately a 15 delta call, somewhere in between the optimal and conservative strikes, give you the best risk reward, the best returns long term if you're selling covered calls over a 10-year period. And a lot of our back test goes back 10 years of history and it captures a full business cycle when we're doing these back tests. And another thing that I want to point out, based on our back tests, this is also interesting because the types of stocks make a difference. So when we talk about which stocks are best for selling covered calls, blue chip, low growth, high dividend stocks usually are the good targets or the good candidates for selling covered calls, like GM, BlackRock, Citigroup, AT&T, Walmart. These are long-standing stocks that have been around for a long time that have high dividends, are usually the ones that are best for covered calls, which is not really a surprise. And then some of the worst stocks for selling covered calls are these mega cap stocks. We talk about the top 5 stocks is, contributing about 30% of the outperformance of the S&P these days. These are high growth stocks. A lot of times they pay 0 dividends or very low dividends, like Apple, Bank of America, Facebook, Amazon, Priceline. These are the types of stocks that we see bad performance for covered calls. So if you're looking at your portfolio, you can usually quickly identify which stocks fall into which category. Blue chip stocks, like I said, are usually pretty good stocks for selling covered calls. High growth stocks are usually not as good. So keep that in mind when you're selling covered calls on stocks that you own in your account. So now that we've kind of covered that, what I really want to do is show you how you guys can very quickly apply the things that we've learned today to your portfolio as easily as possible. So when you're bringing up on the First Trade platform, under the Trading tab, if you click on Options, you will see a button here on the right that says Options Wizard. That will launch OptionsPlay for you, and that's really what we're here to show you today. So for those of you that have never seen OptionsPlay, this is the tool. So when you first log on to this platform, you'll see that the platform is divided into 3 sections. So you have our trade ideas and watch list here on the left. We have our equity analytics panel here in the middle. And then we have trading and income here on the right. These 3 panels represent the what, the why, and the how of options trading. So today, what we're really going to focus on is the income tab here on the upper right, because this is what you can use OptionsPlay to very quickly help you find cover calls and short put opportunities, which can be applied in the same manners that we just explained to you today. So before we get started, when you click on the income tab, you should start off by looking at the default settings here button on the very bottom. This is where, if this is your first time launching OptionsPlay, I highly recommend you to go there first. Like I said, what we were talking about before, making a mental note to yourself is what time frame do you generally fall under, and what risk tolerance you are. By default, everyone's going to be under short-term optimal. Now, you might want to make adjustments based on your own preferences, but like I said, based on our research, the short-term optimal will give you the best results long-term. And this is generalized over, meaning we've backtested hundreds of stocks to get to this data point. You might make small adjustments based on individual stocks or individual holdings you have, but overall we found that the short-term optimal gives you the best returns long-term. But you can set this separately for both cover calls and short puts. So you can set both the time frame and the risk tolerance. And once you save as default, every single stock that you type in, the cover call opportunity that comes up will be based on the settings that you created yourself. So if IBM's trading at 152 right now, you can say, it'll ask you, do you own shares of IBM? You can click on yes. You can enter the number of shares that you own. And what it will do is it will break down the trade for you exactly. So it'll tell you that selling the June 30th, 157.5 calls will produce $123 in income. And they produce a 4.47% annualized return. And there's about an 85% chance that this call will expire worthless. So this stock currently pays approximately a 4% dividend. So you're getting about a 4.47% yield on the cover call, which makes your total 12-month projected yield here at about 8%, 8.5%. So you're boosting your yield, almost doubling your yield by adding a covered call to it. Certainly worth considering taking a look at if you're looking to generate some additional income on your portfolio. So, and this is trading, this gives you approximately an 85% chance of expiring worthless, which is right on target with, based on our research, that about a 15 delta or 85% probability of expiring worthless is the ideal cover call to sell long term if you're looking at our back testing and on our research. So let's just go through a few more examples. Let's say you own Goldman Sachs. For Goldman, it'll say, you can also, again, type in the number of shares you own. It'll tell you exactly that you can sell 3 contracts with the June 30th 227 calls, which generate $393 in income, a 9.9% annualized return. Keep in mind, this is a stock that pays a 1.4% dividend. So you're boosting your yield from 1.4% to about 11% by adding cover calls to it. So certainly a very attractive cover call opportunity to look at if adding income to your portfolio is interesting to you, especially if you own Goldman. This has about a 79% chance that this call will expire worthless. So what I usually teach users is that you go ahead and create a watch list. Whatever watch list you create, what this allows you to do is very quickly click on a symbol and immediately know if there's a cover call opportunity available on that stock. If there is, you get this green check mark that tells you to sell the June 30th 46.5 cover calls. And it will break down the trade for you. And like I said, you use the dividend yield as your guide. So on Halliburton, this pays a 1.62% dividend yield. You're boosting this cover call gives you a 12% annualized return on this cover call. So certainly worth looking into to boost your yield from 1.6% to 14% here. And this has an 80% chance that this call will expire worthless. So right in that optimal range in terms of selling cover calls. Now, let's say you come across a symbol like Ford, which, as you can see, what this is saying is based on currently available options, OptionsPlay did not find an optimal call to find. This is designed also to help you save time, because when you're using an option chain, sometimes you can use that methodology of searching for 1 month calls, looking at deltas of about 0.2 or 0.1 delta, and next thing you know, there's just not enough premium. So you've done all this work to search for the option, then find out it might be trading at 5 cents or 3 cents. So what this is designed to do is really help you save time, so that if a call, there's not enough premium or we couldn't find any calls that made sense, you immediately get this message that tells you we couldn't find anything. And this is designed to help you save time so that you can move on to the next stock. So if you look at the next stock, it'll immediately also tell you, is there a cover call opportunity? So here, because I get this green check mark, it's telling me, yes, I was able to find a cover call opportunity. And this is designed, again, to save you time. And if you ever come across a stock, I'm going to see if I can try to find you guys a stock, maybe on Sprint. Let's see. Yeah. So here on Sprint, I get a different warning. I get a different thing than the green check mark. It's telling me that OptionsPlay, based on the currently available options, that it could not find me a short-term optimal call, and it's displaying to me the next best alternative, which is medium-term aggressive. So this is completely different than what I was looking for. I was looking for a short-term call with approximately an optimal risk tolerance. This is showing me a medium-term call, which is longer dated than I wanted, and it's aggressive. And it's simply the next best alternative that it can find me. So in this particular case, if I was a first-time user, I would simply skip this and move on. I wouldn't sell covered calls on Sprint. But what this allows you to do is also see what else is available. So as you can see, on the shorter dated calls, there's really nothing available. You have to go a little further out and get a pretty aggressive, either the August 10th or the August 11th, to find something that might suit you, or go all the way out to November. So this will also show you the different availability in terms of what's available. So let's say we go back to IBM. You can type in that you are looking for covered calls. As you can see now on IBM, I can see what's available. I can look at, short dated calls, medium dated calls, long dated calls, as well as get conservative, optimal, aggressive. And if you want to make some changes, you want to look at further dated calls, you want to change the strike prices, you can all do that here from this matrix, including if you want to modify one of these trades, you can choose the strike prices right here from here, and you can modify them, change the strike prices, and see how they change right here. Now, the coolest part about all of this and the integration that we've done with First Trade is that once you've found a cover call that you want to sell, let's say, for example, you want to sell this August 18th 160 cover call, when you hit the trade button, what we have is what's called a strategy checklist. This is designed to make sure that you understand the risks you're taking before you place a trade. So we're checking against, what is the probability of this call being worthless. We'll check against that. We'll also check to see if there's a good annualized return. We also check to see if there's earnings between now and expiration. This is a common thing that we see a lot of beginners tend to forget is, they're not aware of, hey, is there earnings between now and expiration? These are things that you need to be considerate of before you sell a cover call. And lastly, the bid-ask spread. You want to make sure you understand how liquid something is before you get into it, because you may have to buy it back later. So understanding how liquid something is very important. But once you've decided that this is a call that you want to sell, all you have to do is click on the submit button. And what it does is it'll pre-fill the ticket for you. So this way you don't have to manually enter an order. You don't have to be afraid that maybe you're entering this order incorrectly, because everything's pre-filled for you. You just have to specify a limit price, change the type of order if you want to change that, and go ahead and send order, and that will fire off the trade. So this is designed to make sure that you guys don't make any mistakes on your order entry, and that the trade that you're looking for on the platform is exactly the trade that you end up executing. So make sure that if you're looking to place a trade from within OptionsPlay, whether you're doing an income strategy or if you're trading, a put spread, whatever it is, when you hit the trade button and you click on that submit, here on the multi-leg orders you can't do that, but on the single leg orders, once you hit trade, you'll be able to hit submit, which will pre-fill the ticket for you so that you can do it all on a single trade. So with that, what I'm going to do is I'm going to open this up to Q&A. And we're going to go through some questions. So if any of you have any questions about anything I just talked about today, click on the Q&A window and we'll be able to answer any questions that you have. So I have one question here by Capril. Question is, are premiums lower on covered calls compared to cash secured puts? That's not necessarily always true, but as a general rule of thumb, that is the case because calls usually trade at a lower implied volatility compared to puts. So if you were selling cash secured puts, you generally speaking will receive a bit more income, especially if you're doing the same dated calls and the same aggressiveness level. So for example, if you do a 10 delta call versus a 10 delta put, the put will probably give you more premium or more income compared to selling a cover call. So a very good question, but generally speaking, that is true. Joel is asking, will this webinar be available to replay? Yes, this webinar is being recorded and everyone that's attending or have registered will be able to have access to a recording of this webinar. Any other questions? Okay, I have a question here. Opinion on CI. Let's take a look at CI. So if you're looking for cover call opportunities on CI, Let's look at this over here. So this is saying that you own 2,000 shares of CI. This is saying that by selling the June 30th 172.5 cover calls, the stock's trading at 166.5. This is telling you to sell the 172.5 cover calls that expires in 22 days, so about 3 weeks from now. And this will generate $940 in premium, which is 4.6% annualized return, and it has an 80% chance that this call will expire worthless. In my opinion, Cigna pays virtually zero dividends because it pays a 0.02% dividend, and so this will allow you to boost your yield from effectively zero to about 4.7%. So in my opinion, this is certainly worth taking a look at, because if you own that much of this stock, you're not getting any yield on the stock from the dividend. Adding a cover call is certainly one way that you can go about doing so. Capril's asking, what's your opinion on selling cover calls around earnings seasons? So that's really why our research has shown that you're better off selling shorter dated calls as opposed to longer dated calls, because selling into earnings is not, from our research, not necessarily a great strategy. But when you're selling long dated calls, you can't avoid earnings. You can only avoid earnings if you're selling short dated calls. So if you sell monthly calls, then only 4 out of those 12-month calls will have earnings during it. The other 9 will not have any earnings, or the other 8 will not have earnings. So keep that in mind. So that's why we prefer selling shorter dated calls, because we have more certainty within that 1 month, because we know 2 out of 3 months each quarter will not have earnings. And that 1 quarter, if there is earnings, sometimes you might not want to sell a cover call, especially if you're very bullish on the stock. So that's what our research shows. We have another question here on Philip Morris. 300 shares of Philip Morris. So Philip Morris is trading at 121 right now. This is telling you that you should look at the June 30th 124 call. So this is about $3 out of the money that expires in 22 days. And this is saying that selling the June 30th 124 cover calls will generate $93 in premium. This produces a 4.2% annualized return. This is on a stock that pays a 3% dividend, so 3.5% dividend. So this stock pays quite a bit, but you're going to still be able to boost your yield from 3.4% to about 7.6% by adding cover calls. So in my opinion, it's certainly still worth taking a look at. Now this is what I would call more of a blue chip stock that doesn't have a ton of growth, has a pretty nice dividend. So these are usually stocks that you want to look for when you're selling cover calls. Whoops. Yeah, Philip Morris, not a lot of premium, but still, if you look at the yield, it's not bad compared to what you're getting on the dividend. The dividend, you don't really need. Capril's asking, what about dividends? You need to consider that when selling. You don't really need to consider the dividend. The only thing you need to consider when it comes to dividend is if you're already in a cover call that's in the money and the dividend's about to come up, then you need to worry about, does it make sense if you were on the other side of that call, would you exercise that call early to capture that dividend? So that's a different story. That's not necessarily for getting into a trade. That's managing a trade once you're in it. One more question on Disney. Would I consider looking at Disney? So Disney pays a 1.47% dividend, which isn't great. This is also a fairly bearish stock right now. So if you own this stock and you want to hold on to it, you certainly want to try to generate some income, because you're probably losing some money from holding on to this stock. So this is saying, look at the June 30th 108 cover calls. This stock's trading at 104 right now, so it's about $4 out of the money. This is telling you to sell a call that's $4 out of the money that expires in 22 days. And this will generate only $28 in premium per contract, but that's a 4.5% annualized return, and you have an 85% chance that this call will expire worthless. So you're taking your yield from 1.4% to about 6% by selling this covered call. And considering this stock's taking a beating, I certainly would think that this would be a strategy that you would want to deploy if you want to hold on to Disney in the long term. We have one more on Target. On target, this is stock trading at $54 right now. This is telling you that you can consider selling the June 30th 57 call, so about $2.50 out of the money. Same thing, 22 days away. This stock pays a pretty hefty dividend here at 4.4%. And as you can see here, this selling this cover call gives you 21 cents and $21 in premium per contract, which is a 6.3% annualized return with an 83% chance that this call will expire worthless, bringing your total yield to about 10.7%. So again, certainly one that I would consider taking a look at. The other question I had was taking a look at exit trades. So I will cover that in 1 second. Let me just get to a few. Let me just do a few other things, and then I'll talk about exit trades. Deborah's asking, can you explain the covered blocks at the bottom of the chart? And it's really simple. So what you see here on the top of your screen here is a 1 month and 6 month trend indicator. So this gives you the current snapshot of what the current 1 month and 6 month trend is. These color blocks down here tell you how that trend has actually changed over time. So today it's 1 month and 6 month trends are bullish, but this will show you that since April 24th, those trends have turned bullish. So not only can you see what the current reading is, but you can see how that reading has changed over time. So that's really what that 1 month and 6 month trend refers to. I have one last question about USO. Generally speaking, I found that there's not a lot of premium in USO. So as you can see here, on USO, I get a different outlook than I normally do. So it's saying that I couldn't find you a short-term optimal. It's displaying me the next best alternative, which in this case is long-term aggressive. So not the best stock to sell a cover call on, in my opinion. So let's just talk about some exit strategies real quick. So when we talk about exit strategies, I can't cover every single scenario, but there's three major scenarios that I think we can think about. Once you sell a cover call, three things can happen. The stock can go higher, the stock can go sideways, the stock can go lower. And I just want to cover these three general scenarios as to what you can do. Probably the one that's most stressful for people and when they tend to panic is if they sell a cover call and the stock shoots higher. It goes right up to the strike price or maybe even above it. And a lot of times this is where people struggle to understand is like, what should I do? Should I close it out? Should I roll it out? I'm going to lose my stock. What should I do? And the best answer for you is to don't panic, especially when this happens. The last thing you want to do is panic and close out at a loss and things like that. Best thing to do is hold on to this cover call. And if you need to roll, wait till the last week before expiration to roll. So if you hold on to it and the stock continues going higher or stays above the strike price or stays near the strike price, that's okay. Hold on to it until near the last week before then you roll it, because then you're able to capture the time premium or the time decay to your full advantage before you have to roll a cover call. If the stock goes sideways, this is sort of your best case scenario, in my opinion, when it comes to cover calls. You're not losing money on the stock, but you're making all the money on your cover call. You essentially can hold your cover call all the way to expiration, let the call expire worthless, and do it again. This is best case scenario because you don't have to buy the call back and potentially pay a commission. You just let it expire worthless and let it and do it all over again when the call has expired. And lastly, if you sell a cover call and once you get in it, the stock plummets, this is good from the cover call perspective, but obviously not good from the stock that you own. So this is one of the few cases where it does make sense to roll early, and this is where you can roll your strike down. So if you sold the 105 strike and the stock drops to 95, then maybe you want to roll that 105 down to a 100. What that allows you to do is it locks in your profits on the 105 cover calls very quickly so that you can do it again at the 100 strike, and start writing a cover call again. And this way you're locking in your profits and rolling it down. So those are the three general scenarios as to what can happen when you're selling a cover call. Capril's asking, which ETF do you recommend for cover calls? The answer is none, because cover calls is a strategy for the stocks that you already own in your account. It's not a strategy for you to go out and buy an ETF just to sell cover calls on it, because it's not worth the risk of buying a new stock just to make a couple of percentage points, because cover call by definition is a strategy with limited reward, because you're limited to the premium that you're receiving. You're taking on a whole lot of risks to the downside by buying that ETF. So that's why this is not a strategy that you go out, buy a new stock just to sell a cover call on it. You do it on the existing stocks that you already have in your portfolio, and on the stocks that you want to continue holding on to for your portfolio. I hope that made some sense to you. Any other questions regarding cover calls or any of the things that we talked about today? You can do cover calls in any portfolio or any types of accounts. Obviously, if you do it in an IRA account, the proceeds are tax deferred until you withdraw your money. But you can do it in any account. If you do it in a regular account, the income you receive obviously is taxable. If you do it in an IRA account, it's not. Vittorio, you're very welcome. I hope you guys have found this useful. Any other questions? The question about the watch list is different from the watch list on the main screen. I'm not sure which main screen you're referring to. I'm presuming you mean the main screen of First Trade. If that's the case, no. The watch list within OptionsPlay is specific to OptionsPlay. So what we've built is a spider sector watch list, so you can see kind of which sectors are strong, which sectors are weak. So as you can see, I sort it by score, so I can tell you exactly that energy is a very weak sector, but technology is a very strong sector. And the scores will allow you to quantify how strong and weak each sector is. And then it also allows you to dive into each individual sector. So you can see all the stocks within a sector. So I can tell you Urban Outfitters, Ralph Lauren, Nordstrom, these are the weak stocks, the score of 1. And then, stocks like Amazon, McDonald's, Priceline are the really strong stocks with a score of 9. So these watch lists are designed specifically for OptionsPlay to help you quickly identify what are the strong and weak sectors and what are the strong stocks within each sector. Lisa, if you're just getting started, that's okay. Everyone has to start somewhere. This is designed to help make that starting point easier for you. Like I said, for those of you that are new, make sure that you come in here, put in your default settings. Like I said, we always start you off with the short-term optimal. You save that as default, and that's all you need. Type in a symbol of a stock that you own. Let's say you owned, Bergen. You type in the symbol and it'll immediately tell you if there's a cover call opportunity. If there is, it'll break it down for you, just like the examples I gave you today during the webinar. All right, guys, thank you so much for joining me this afternoon. We'll be back in the next few weeks to talk about some different topics. And until then, thank you very much for attending this afternoon. I hope everyone has found this useful. All right. Thanks, everyone, for attending. I hope you guys have a good afternoon, and I'll see you in a few weeks on our next webinar. Thanks, guys.